The broadcast is now starting. All attendees are in listen-only mode.
Hi everyone, and very good evening to all of you. Before we proceed, I just want to confirm whether I am audible clearly. So, if you guys can actually see me, if you guys can actually listen to what I'm saying, and can you see this, please type something in your box over here. Can you do that? Please type something in the question box. Please type a yes or audible in your question box if you can see this. So I see a ding over here. Ding, can you hear me? Is this text visible? Let me see what is the audience view. Yep. Okay, great, fine. So finally I see Ding responding. This great. Thanks for this. Now I think let us start with today's session. And so today I'll talk to you about some common best practices that we should follow in financial modeling. Now, before I start, can you let me know, Ding, what is your background, and is there anything specific that you would like to learn in today's session? If you have anything in your mind that you would like to know. So in that case, I can sort of try to maybe even cover that part. So do you have anything in your mind as such? No? Now, just could you also just let me know if you received the Excel sheets, because we are going to work today on Excel sheets. And okay, you are a financial analyst, and great. Which company do you work with? And if you are a financial analyst, I guess you would be generally comfortable with the idea of income statement and balance sheet. So I guess that would make it somewhat easier for us, right? So I mean, before I start, I just want to check out if you are aware and comfortable with the terms like depreciation and cash flow, because we are going to actually sort of do things related to these items. Yeah. Okay. You're working at C. I mean, which city are you from? Corporate biotech. Okay. Boston. Okay, great. So yeah, so that's good enough for me to understand it, and let us start. Okay. So see, the key in the agenda for today's session is going to be we'll try to look at a couple of items, and primarily in these items we're going to look at how to actually model depletion, and then when you talk about depreciation, how to actually model that. That is going to be one of the things which we're going to see. Then we'll see something about the use of how consistency helps a lot when you're trying to do modeling, and similarly when you're trying to model the taxes, what all things should we take care of. And at the end, we'll also try to see how we can look at modeling of debt and cash balances. So all these are again independent items, and we are going to do a very small exercise on all of them just to get a feel of it. Yeah. So coming to this, let us move ahead and move to the next slide. So the key concepts which we hope to learn today would be on scalability, and we'll see how to make a robust model. When I say robust, it means that even if I put in some wild assumptions, the model should still work and it shouldn't crash. Then we'll see how to look at modeling of cash balances and debt, and looking something at modeling taxes. And taxes, of course, all of us in US, taxes are so important. So we'll try to see how to sort of avoid some common pitfalls when we do some modeling for taxes. Now, typically building a financial model is, it's a fairly challenging task, and the key thing which I have learned during my investment banking career is that one should try to always follow the best practices, because it's very difficult to find out a bug or an error once you've committed it. It's like programming. It takes more time to find out a bug than to write a new program. So we'll try to see some key things which we will use. To begin with, let us start with modeling of depleting items. So let us try to understand this using a spreadsheet, and let us see how it works out. So let us take the unfilled template with us. So I hope you've already got this. Okay. Now, do you have this template with you? Yeah. So I'm assuming all you guys would have got this unfilled template on which we can actually start working. Yeah, everybody could just confirm whether you got this Excel sheet. If not, of course, I'll send it across to you in due time. But just to get an idea from you guys, do you actually have it? No? Okay, fine. Can you give me your email ID? I'll just send it across to you. Yeah. So those of you who haven't got this template, could you just mail me your email ID? I'll just send it across very fast, because then it will be very easy for us to work on this, right? Okay, so xjding2005@hotmail.com. So just check your email ID, xjding2005@hotmail.com. Okay, Ding, could you just check your mail? I just sent you the template. Let me know if you already got it. Yeah. You could just confirm. Not yet. Just one more minute, and then since you are a financial analyst, I guess we will straight away work on the Excel sheet. Just give it a minute. I've just sent it across. Yeah. I guess others are also now ready, and we can got it. Perfect. Just open it in your Excel, and once it is open, let us start working on it right away. Yeah. So there are 4 key things which we are going to learn today. One is how to work on these depreciation calculation, how to look at something on scalability, which is more consistent with the format, then looking at taxes calculation, some basic stuff. Now these are again very simple things which we are trying to sort of learn just to avoid any major problems down the line. So of course you must have heard of Murphy's law, wherein something can go wrong, it will go wrong, and we hope to really at least keep certain things right so as to make sure that things are fine when we build a large model. In a small model things are okay, but in a large model it's very difficult to even figure out what's wrong. Okay, so are you all set? So luckily we have a class of people in finance. So we have thing from Boston, we have somebody from Chicago. Okay, somebody, yeah, so we have one more person from Washington. Okay, great, fine. So let us start. Should we start? Yeah. Yes, okay, great. So let us look at depreciation. I'm quite sure all of you are already aware about the concept of depreciation. So let us try to quickly work on things, and since you're working on Excel along with me, it will be easy to understand things. So let me increase the view. So this is what we have. Now if you look at depreciation, let us look at only SLM, which is a single straight line method depreciation, and we have made certain assumptions. So we've assumed that the gross block or my assets are 100 and we are depreciating it at 30%. So typically what happens, let us say the assets are in FY14. So once we depreciate in the first year, we depreciate for 30 and the net value of the asset is 70. And if you look at FY14, the total depreciation so far is only 30. If you look at FY15, what happens is that we have another depreciation of 30, but not the total depreciation is the depreciation till last year plus the new depreciation. So when net block becomes the total asset minus the total accumulated depreciation. Is that clear? So once we do this for 30, 30, 30, what we do is every year we start depreciating things. Now what happens is, generally what I'll do is I'll simply try to copy paste the formulas. We'll do this over here. So I say fine, my depreciation is equal to, this is my gross block into my SLM depreciation every year. I protect it with the formula. I say this is my depreciation. What's my accumulated depreciation? Is my depreciation last year plus my depreciation in this year. And what's my net block, which is equal to total asset minus this. Now if I copy paste this formula over here, I end up at minus 20. Now this is a problem. Why? Because my net block cannot become negative. So after depreciating for 90, ideally I should only be able to depreciate only till 10. Why? Because my total assets are 100. I already depreciated to 90. In the last year I cannot depreciate. So this number is definitely questionable. This number is questionable. So how do I protect this? So my only key thing is that in a particular year when I'm trying to depreciate, my depreciation should not be, so this number should be minimum of whatever is the actual remaining plus whatever is my formula. So my depreciation should be equal to this into this. This should be equal to minimum of this into my gross block. And I should copy this formula over here. So now if I copy this formula everywhere, if you look at this now, what's my formula? My formula says my depreciation for a year is equal to the minimum of what was in the last year or what was remaining of my net blocks. For example, in the fourth year, what happens? In the third year, my depreciation is 30, so my net block is 10. Now my total net block is 10, so in the next year I cannot depreciate more than 10. So this minimum function takes care of that. Now see, by using a simple minimal thing, what we've ensured is that fine, we are not looking at some funny situations in my balance sheet wherein my net block is shown to be negative. Are you getting this, everyone? If you do a straight line method depreciation, I mean, because it's 30, 30, 30 every year, if I depreciate it for 4 years, it's going to be 120, which is wrong. I cannot depreciate an asset of 100 by 120. I just can't do this. So how to check this? I say that fine. Every year I check what is my supposed to be depreciation, which is around 30, and what is my actual asset remaining, which is around 10. And if my actual asset remaining is less than what I should depreciate, then I will depreciate the whole asset, which is 10, and get over with it. Are we clear with this? So that's one simple technique, but it works very well. I mean, so using the min function to avoid such situations is very, very common in finance. Especially when you talk about balance sheet and taxes, we look at items, for example, this item goes into our income statement, but generally we create a depreciation schedule separately. And based on this, we pass on entries to the balance sheet and the yearly depreciation to the income statement. So understanding this is very, very crucial. Yeah, so yes, Annie, Ding, John, everyone, are you guys getting this? Robert? Any doubts, or are you able to appreciate the usage of min function? Yeah. So just for your convenience, what I'll do is I'll simply for your convenience, I'll simply write it down for you guys. Yeah. Simple. It's very elegant, just taking care of this. This number should be minimum of this and this. That's it. Yeah. Great. So if this part is clear, let us look at the second thing, which is more, again, not difficult. It's going to be very easy, not a problem at all. So let us see what I'm trying to say. See, what if you look at this particular model, okay, what has happened is that sometimes what happens, we use the interest expense and we sort of report it yearly. So FY14 it was 12, then 10 and 8 and 20 and so on. And in some other sheet, I've put the years like this. See, they're vertical. So this is now vertical. Over here it was horizontal. Now if I try to do a transpose from here, okay, and if I try to do this 12, 20, 10, 8, 20, and I try to put this transpose in the interest portion, okay, over here I don't use 18 and over here I use FY18. So because of this transpose also it creates problem. So see, the problem is over here it was like the rows are having the years one by one, and over here we are having columns, I mean the rows are having the years one by one. Now one should never do this. That creates a lot of problem. I mean, because see, let us see, FY16 is 8, the interest expense, and over here it is coming to be 8, but FY17 it is 20, it is coming to be 6. So when we copy paste in Excel, okay, it always creates a problem in terms of if it is not linked properly. So this is a very, very useful function. One has to be very, very careful on this. Okay. So what we should do is, okay, so let us calculate the interest. Let us try to create this. So the key lesson or the key understanding over here is look at this right approach of creating this particular columns. Now they are again, they are sort of again horizontal. So if you look at FI14 is whole FI14, 15 is 15. So another thing important to learn over here is that in financial statements, if I'm using column K, which is this column K for FI14, I should use it for FI14 everywhere. L is for FI15. That's known as something integrity of data, as in it's known as you should sort of try to keep all the yearly data in a single column. That's very, very crucial. So now let us try to look at this function. So what we have here is that we have a debt for a tenure of 5 years with an interest rate of 12%. So the EMI or the yearly payment is given this function PMT, and we can calculate that this is the principal, this is the interest rate, and this is the duration. So we got it as 28. Now, so what happens is that fine, we can say that the yearly payment is 28, and this is the yearly payment, so that is going to be same for all of them. Okay. Now interest portion. In the first year, what's the interest? The interest portion in the first year would be total debt into the interest rate, which is this. So what do I say? That fine, this is my interest rate, so I lock it over here. And so out of $28 or $28 million which I pay, so what has happened is I've taken a loan of $100 million which I will repay in 5 years. So every year I pay a fixed amount of 28. But what happens in the first year, I'm paying a lot of interest and less of principal. So I'm paying 28, out of which 12 is my interest. So I say fine, this is 16 is the principal. So now what has happened is, what's my balance principal? So out of 100, I already paid a principal of 16. So my principal remaining is 84. So I took loan of 100, I paid back 28, but out of 28, 12 was my interest, so 16 was my principal. So after the first payment, the principal is 84. And what's my next interest? So my next interest would be, this would be equal to essentially this into this. So what I can say is that fine, if I simply copy paste it, that is my new interest payment. So what happens, look at this function now. So my interest for 15 is the principal, which is 84, into the interest rate which is given in 12 by the green block. So next year when I pay 28, I'm paying 10 towards the principal and 10 towards the interest and 18 towards the principal. So by doing this within 5 years, I end up paying all my principal. So my principal balance becomes 0. Right. So this is of course a very common thing which all of us must have already done when we try to calculate the interest expense. So when the company look at interest expense, and then I can again link this to my interest expense, and this is how typically it goes. Now the key thing to note over here is that if you are making a model, then don't mix your columns with rows. Over here all my rows are exactly in the same column. So it's FY14, it's FY14. If it is FY16, it is FY16. Unlike in this situation wherein it's a mix. So the key learning in this case is, when you're trying to make a model, you have to make it scalable. You have to make sure that there are no problems. It's very similarly formatted. So the column integrity has to be maintained. The matrix integrity has to be maintained. Do we get this? So again, there is no trick into this, but it's again, as the topic of the webinar is, it's more about the best practices in financial modeling. Yeah. So are you guys sort of okay with this whole idea? See, in financial modeling, a lot of things are very easy, but yeah, that is wherein lies the devil. The devil lies in the details. So we need to be clear as to what are we doing. Are we clear with this? Robert, Edward, Annie, John, Ding, are you guys okay? So just remember this, the key learning is keep the years in columns. Okay, that's the best way to model things. Don't put them in days like this. Don't do this. Yep, clear? Okay, great. So let us move to the next important part of our lives, which is taxes. Okay, now when we work on taxes, okay, let us try to see what is so great about the taxes. So tell me guys, are you clear with the concept of taxes? That if we, what is PBT? PBT stands for profit before taxes, and cumulative PBT is the total profit before taxes up to a particular year, which is made by adding up these numbers. So we'll just calculate that as well, how to do that, and then we will see how we are getting some taxes. Now if you look at the leftmost column, okay, so let me try to replicate this leftmost column. So I say that my total PBT is equal to this year taxes plus my last year cumulative. So this is equal to this year plus my last year PBT. So when I do this and I do a control R, what do I get? I get the same number. So what I'm saying is that my first year, my profit before tax was -6. Fine. So my cumulative PBT is -6. Next year I have -2 again. So I say -6 plus -2, which is, you can see the plus sign, it's -8. Then suddenly I make a profit of 10. So -8 plus 10, that gives me 2, and so on, right? So every year, as I'm making losses in these 2 years, but my cumulative profit is like this. Yeah. Now if you look at the whole way the taxes are calculated, typically the first golden rule in taxes is that if you are not making a profit, you don't need to pay taxes. So if you look at year FY 14 and 15, I mean, there are no profits, so there can't be any taxes. Look at 16 and 17, there are profits and there are bound to be some taxes. So that is first rule, rule number one. So whenever we do calculation for taxes, we need to check whether there are actually any sort of whether there are any profits or not. If there are no profits, there shouldn't be any taxes at all. Okay. The second thing to check would be even if there are profits and if there have been losses in the past, so the governments, the tax guys always allow you to accumulate your losses. So let us say if today in the last 3 years I have not made any profit because I had losses in the first 2 years, I'm not supposed to pay taxes. That's how typically the whole idea works. Now let us see how we are sort of trying to calculate the taxes over here. So what I'm saying is that fine, one way to do taxes would be fine. This is my profit before tax, and I say fine 1 minus what is my total tax rates. Okay, so that is one way of doing it. So let us do two checks to understand. But again, remember the taxes can either be zero or they can be something. You can't have negative taxes. I mean, the government would not give you any money if you have losses, right? That's what negative taxes would mean. So all of us know, right? The government doesn't give us money when we make losses, isn't it? Correct? So how do we model this? So we have to check two things. So let us try to do this. We say that fine, if there are losses in a year, then there are no taxes. I hope all of you are familiar with the if function, right? So I'm saying that if there are losses in a particular year, then there are no taxes. But yeah, I mean, even if there are some profits, right? Still, we need to check whether the total losses are still negative or not. Are you getting this? Everyone, just take a minute to ponder over this. What I'm saying is that in a particular year, okay, if the PBT is negative, then you don't have to pay any taxes. That's one part of it. So what it is, if PBT is negative, don't pay any taxes. Then we check again whether the cumulative PBT, okay, how is that doing? So my cumulative losses could be negative, could be positive. Even if that is negative, it means that I have made losses this year. And if you look at all my losses on profit so far, I'm still in losses. Still, it has to be zero. But if my losses, but if I make profit this year and I make losses in accumulation, still my tax is zero. So the only thing we have to check now is if my PBT for this year is positive and my total PBT is positive. So now we have come to that condition. If both the cases are true, then we say that fine. In that case, we should take the tax rate and multiply it with minimum of my PBT or the accumulated PBT. Why I'm saying this? So let us take a moment to understand this. So this formula looks maybe slightly complex, but essentially it is fairly simple in that respect. Okay. So what we're trying to do over here is we're trying to say, let us look at this case. Okay. Let me make this as 10, right? Let me make it as 6. So what happens? So minus 6, minus 2 and 6. So this year actually I made a profit of 6. What happens? Or let me make it, yep, 6 is fine. So even, so now you see the beauty. I have made a profit of 6 in FY16, but I am not paying any tax. Why? Because my cumulative number is 2, minus 2. So in the last 2 years, I made a loss of minus 8. So if you add up these three guys, okay, the total is minus 2. So in first year, no profit, no tax. Second year, no profit, no tax. Third year, there is a profit, but the previous losses are eating out into my profit. So I'm still in loss at the end of 3 years. So still no tax. And the fourth year, when I make 15, my total profit till date in the last 4 years is 15, is 13. So I'm paying taxes on this. So this is the key thing over here to understand is that look at and contrast this over here. I mean, this is there is a small change in this formula. Over here, even if it is 10, there are taxes of 3. No, this is not the right thing to do. The right thing to model the taxes would be here, wherein we take care of everything. The taxes are going to be only 1 in this year and 5 over here. Are we clear on this part? And please also note there are no negative taxes. So I mean, either you pay tax to the government or you don't. I mean, nobody gives you money as in the way it has been shown over here. So this is one way of modeling taxes. In modeling taxes, essentially just copying, copy pasting a formula doesn't work. One always needs to check what is the actual impact and what is the situation right now. So that can only happen once you sort of model it correctly. Now, even if I make it 8, 2, 10, 45, it doesn't matter. All the numbers are taken care of. I don't need to bother about it. Even if it is -3, it's fine. Instead, if I change things over here, I mean, things would still change. See, 6, 2, things are still not changing. A lot of things are different. If I make it 3, I make it 8. Sorry. So, I mean, the idea is to do a right calculation, and it's not very difficult if you follow the right approach. The right approach, or the key learning in this case, is try to check the boundary conditions. So the key to understand is if my taxes are showing to be negative, definitely I am doing something wrong. Yep. Everyone? Annie, Robert, Edward, Ding, how are you guys doing? Are you able to understand the key principle behind this? So whenever you're making your income statement or balance sheet or taxes, please check whether you are supposed to pay taxes. Please use an if condition to check whether things are positive or not. Yeah. I hope you just also remember that we need to follow the matrix integrity of years. And over here, we used a very beautiful function called min. So let me also maybe write down this function for you guys over here. Yeah. Okay. So what I'll do is I'll write down this function for you. Okay. Can you see this now? Just for understanding. Yeah. Anybody, any questions so far? Anybody, any questions, anything which you guys would like to understand now? Again, let me emphasize the key checks and balances in financial modeling are more towards putting in the right boundary conditions. Yeah. And it generally takes care of a lot of stuff. It's just a matter of putting some caution. Yeah. Should we move ahead? Yeah. Okay. Okay, Annie, we can move ahead. Yes. Okay, Robert. Yes, we can move ahead. Fine. Ding, what about you? Because you got the Excel sheet at the end. So, yeah. Are you clear? Do you have any questions, guys? Please feel free to type your questions over here. Okay, no more questions. Let's move to the last part of this sheet, which is on looking at the cash flow statement. Okay. And let me sort of try to maybe draw your attention to the key points and or the key problems which we see in this cash flow statement. So this is my one cash flow statement which I have already filled. Okay. So let us see. Can anyone tell me what is the problem in this cash flow statement? This has been actually made nicely. So, but do you see any particular problem in this cash flow statement? Anyone? Can you guys figure out the key problem in this cash flow statement? This one towards your left. I mean, when I'm talking about this, I'm talking about this cash flow statement. Can you see some problem in this? Okay, somebody is saying that the assets and liability, they are matching. Assets liability are matching. Okay, okay, great. So I think Robert has answered it correctly. See, the key problem in this is that we're talking about balance sheet and we are saying that the cash is minus 2 million. Again, the cash cannot be minus 2 million. Can a company have negative cash? No. Essentially what happens if you're running out of cash, you go and take some loan from the bank, which could be a form of short-term loan, a working capital loan, an overdraft, you call it whatever you feel like, but you can't be negative cash. Now, but when you try to make the cash flow statement from your balance sheet and income statement, it can be negative because cash is a balancing figure in accounts. So when we make the projections for anything, we can always end up in negative cash. What does it mean? It means that the company gets a signal that, hey, look, I mean, you can run out of cash by $2 million, so you better borrow it up before you run into that. So now we'll try to see. So whenever we make a model, we need to be very sure that the cash should not be negative. Is that fine, everyone? So how do we do that? Because these are projections and cash could be negative. Secondly, also see this line. So if you look at this line, this minimum desired cash balance, in reality what happens when you run a business, you run a company, you would say, fine, I just can't work on 2 cents in the bank account, I need some money for any expenses. So even though I need to borrow something, I'll rather borrow $1 million extra just to ensure that my bank balance still remains positive by 1 million, because in business you never know when you need to pay cash, you need to do something. So if you're short for 2 million, you better go and borrow 3 million, because you always need $1 million of plus cash. So with this context, let us try to build a model in which we try to get a basic cash number, right, which should be taken from the other statement. Let us try to build this. So the yellow block, see, I mean, we have to actually build these blocks and understand this. Now the first thing which we need to do is to let us try to build these assets one by one. Look at balance sheet. Now what is net block? The net block is equal to gross block minus the accumulated depreciation. So this is my net block. So I say, fine, this is my net block. So my total assets would be equal to how much? My cash plus my receivables plus my inventory plus my net block. Remember, you don't add gross block to this. So I say this is my total assets. Note that I have not put the cash numbers so far because we'll do the calculations for it. Okay, but this is the way it will be linked. So in Excel, again, the other rule is that when you try to link something, link it fully even if there are numbers not into the model right now. Okay, this is typically how we're doing it. Let us look at the other parts of this. Let us leave the cash, but let us try to figure out the other parts one by one. What is PAT? PAT is your total profit after tax. Now since it's a very simple model, there are no dividends, I can assume that whatever profit after tax the company got was already put into the retained earnings or equity of the company. So you know, I hope all of you are very familiar that when you make profit after taxes in income statement, and if it is not paid out as a dividend, it goes to the equity. So I'm saying PAT for FY 16-15 would be equal to the total retained earnings equity minus the last year equity. If I do this, I get the PAT for this year. Similarly, I want to find out the depreciation. So I say, what is the depreciation? I know that the total accumulated depreciation for this year is 18 and the last year it was 15. So I must have got a depreciation of 3 in this year. Again, I do this and I get this number. What about working capital changes? What are working capital changes? Working capital will be equal to my receivables plus my inventory of this year minus my payables of this year. This is for this year minus from the last year. So again, we do this of this plus my assets, working current assets minus my current liabilities of the last year. Fair enough? So that gives me my working capital changes for every year, right? So remember, if my working capital increases, right, if my inventory increases, what does it mean? It means that, just to give you an idea, my inventory has gone from 10 to 13, so it must have eaten out some cash. So I need to do 13 minus 10 plus 10 minus 8. but my payables has also gone up. So essentially this is how typically I see the impact on my cash from the working capital perspective. So now I've got these items with me. Now what else do I need? Let us see what else do I need. Debt. Okay, great. So initially my debt was 14. Okay, let us look at the debt numbers. So this year my debt was 14, and what happens next? I really let us look at some cash balance also right now. So if my what are my total liabilities over here? My total liabilities over here are my payables plus my debt plus my equity, right? Do this. Does my total assets and total liability match? They don't match. Why they don't match? Because my debt number is still not there and my cash number is still not there. Okay. So what will I try to do now? I'll try to figure out what could be my cash balance, right? Now what's my opening cash balance? My opening cash balance of FY14 should be my closing cash balance of FY14. So FY14 cash was 2. So that was the total cash which I had at the end of FY14. So when I started FY15, I started with the cash of 2. Now with cash of 2, that was my starting for 15. I added 6, my PAT, I did depreciation, I reduced the working capital changes, I did a capex, I made this payment. So what will happen? My eventual cash would become this plus this plus this minus, or I can say, I would say this is equal to sum of these three guys minus sum of these three guys. Now do you see the problem in this? The expected cash balance is coming out to be 2 minus 2. Let us do this. So I'm saying fine, this is minus 2, but now this is a balancing figure, as you must have seen right now. This is from projections. I take 2, this is what I'll have. So do I have a shortfall over here? So my cash balance which is projected is minus 2. I will need 1. So to achieve a cash balance of plus 1, when I'll get minus 2, my shortfall should be equal to my expected cash balance minus my desired number. Correct? Is it fine? So do I need to borrow something for this? The idea is yes. How much do I need to borrow? I need to borrow the shortfall if it is negative. If it is not negative, then I don't need to do anything over here. I can say that my shortfall would be equal to minus times minimum of this number and 0. Can you see this? What does this mean? Can you see this? So what it means is that if my shortfall is 3, okay, my shortfall is of 3, then I need to borrow 3. If my shortfall was plus 5, I mean, I don't need to borrow anything. Let us try to copy this function over here. So right now, what is the actual cash balance? So shortfall is 3, I had to borrow 3. Now go back to the total, what is the actual cash balance? If my actual cash balance would always be equal to either the minimum desired cash balance or the expected cash balance, whichever is larger. Correct? So actual cash balance is going to be maximum of this or this. Why? Because if my expected cash balance is negative, I'll borrow 3 and I'll come 1. If it was positive, I'll not borrow anything, I'll go ahead. Correct? This is how typically it will work. Now, but there is a small problem in this. Now, the problem is, what is my cash balance for FY? So if you look at this part, what is the cash balance for FY16? Cash for FY16 would be equal to the closing balance of FY15 and so on. Can you see this? So let us go from the beginning. What has happened is that my expected cash balance was -2. I wanted a balance of 1. I took a loan of 3. My cash became 1. Now this was the cash balance for 15. When I started year 16, I started with this cash balance of 1. When I started this of 16, right, what I needed to do was I started from there, and then my expected cash balance came out to be 2 over there. Now, since I am already more than 1, do I need anything? I don't need anything, right? So this is my shortfall. Do I need to borrow anything? No, I don't need to borrow anything because it is already positive over here. Now, what is my actual debt in this case? So my debt for this year should be equal to my debt of last year plus any fresh borrowing which I have done minus any debt repayment which I have done. In this case, where is the debt repayment? This is the mandatory debt repayment. If I do this, I'll get this number. Look at the balance now. My total assets have become 30, 41, 50, 55. And the liabilities become this. You see, these are actually now balancing. Can you guys see this? This is balancing now with this figure. If I don't do this, let me remove the steps one by one. You see, this is not balancing right now. These two guys are 37. This is my total assets, right? So let me in fact color code it differently. Yeah, just to sort of maybe give you a better idea on this. Yeah, so let me color code it using a blue color. Okay, and let me go to assets and liability, and let me color code it using a green color. See, they're not balancing right now, but the moment I copy this formula, see, they're balancing. 50 is 50 and so on. Now the whole thing to understand over here is that you cannot have a negative cash in your balance sheet. That is the key learning over here. To avoid this, right, we use the functions of minimum and maximum, right, everywhere, and we are able to actually do an actual cash balance of 1 to 3, which is in line with this. So we had to borrow 3 once, and then everything else was taken care of. Now if you look at this, okay, even if I change my numbers, if I change my projections anywhere, things shouldn't change. So instead of 10, if I make it, let us say 34, see, the numbers would have changed 23, but I am not, my actual balance is 1, 6, and look at the assets, 65, everything is balancing right now. Nothing changes. Can you see this difference? Or if I make it 3, still. So you can see all this, but if you look at the balance sheet items, the cash numbers are very, very same. So we have this minimum cash balance of 1 everywhere. You're not seeing negative cash balances. That's the key in modeling cash flows. When you're trying to model the debt accordingly, you look at the initial debt plus what you had to borrow, which is actually based on the cash flow, and the repayment of debt which you have done. Is it making some sense? Or is it too fast? Yeah. So I'm sure once you do it on your own, you'll get a right idea as to what things are and how things are moving. But this was just to illustrate the whole power of doing proper financial modeling. And believe me, the key thing in financial modeling is more on sort of trying to follow the right principles and knowing some basic things, right? So let me just recap quickly before we come to the end of the session. The first lesson that you have learned is try to use the functions like minimum. Okay, they should be used and they should be used realistically, because in this case for depreciation, you cannot depreciate an asset for 30 if the asset is only 10. That's the key thing to learn. And to check that, we can use either an if function, but minimum functions or maximum functions, they work very well. The second lesson to learn is that if the years are given like this, then don't try to model them horizontally. Always keep all the years in one column. K is for 14, L is for 15, and so on. Whatever suits you. The third lesson to learn for today is when we're trying to model taxes, we have to do 2 checks. The first check is what is my profit for this year, and second, what is my cumulative profit for this year. And if the cumulative profit is less, then we tax on the lesser number. You can see 1 because that is rounding it off. If I do exact number, it's not 1, it's 0.68, right? So rounding off is important. So that is the key learning in taxes calculation everywhere. And the last learning is on taxes is on cash flow modeling. In cash flow modeling, the key thing to learn is you cannot have negative cash in your balance sheet. Look at these two numbers, is 2 minus 2. You cannot have negative cash in the balance sheet. So what you do, you actually do extra fresh borrowing, and then you try to put them in your balance sheet and model it. The cash cannot be negative. So these are the key 4 lessons which we thought we will learn in this. I mean, the slides contain the details of this, but I'm quite sure that if you guys actually follow it once, there is no reason why you wouldn't learn this. But of course, the key thing is to do it once, and then you will remember it for your life. Yeah. So during my iBanking stint, I used to learn this. I mean, yeah, we are going to a company, we have to learn this. That's how it works. Yeah. Okay, Ding wants to follow the formula in the cash shortfall. Yeah, sure, Ding. I mean, of course, what we are going to do is that, should I write the formulas for you? Wait a minute. Which formulas do you want? Do you want to see these formulas? Okay. Okay. So what we can do is we'll send you the solution sheets as well. Of course, you need to practice it, and we'll send you across the slides as well to understand this in detail, right? But what I need you to understand over here is that the key thing is the net block, I think, is very easy to understand. Net block is nothing. It is your gross block minus this. The depreciation, the debt is what is your debt of the last year, okay, plus new debts you've taken plus debt repayment. So this debt repayment is also given over here, and the fresh borrowing is also given here. If you look at the cash flow, this is my opening cash balance. This 2 is my cash from the last year. So the opening cash of this year is the closing cash of the last year. Then I add the PAT and depreciation. That is the indirect method of calculating the cash flow statement. We do this. Capex, we get the expected cash balance. This, look at this number, it's expected cash balance, which is nothing but the sum of first items minus the 3 items. But we actually need 1. So, I mean, the expectation is minus 2, we want 1. So we need to do a fresh borrowing of 3. If my expected cash balance is positive, then I don't do any fresh borrowing. Yeah. So based on this, I feed this number into the cash balance in my balance sheet over here, and then at least I get a rational cash flow statement with an actual balance sheet which is still positive. Yeah. Are you with me? So of course we will share these presentations, and we will put it on a blog so you can follow it from there. But I hope the basic principles are sort of understood over here by everyone. So Annie and Robert, I guess you guys are getting it. Okay, good. Great. So I hope that brings us to the end of this particular webinar, and I hope you guys really at least learned a few things, and if you actually practice it, I'm quite sure it will be very helpful to you guys in the future. And we'll be conducting the next webinar as well, I think on 5th of June. So if you really want to learn some new tricks, and do enroll for it. And even if you want to know something in particular, do write a mail to us, and we will see if we can incorporate that in our next webinar. Yeah. So hope it helps a little, and we will put up details on the blogs, and you guys will be able to know more about it. And thanks for spending your precious 1 hour just before the weekend, and I hope you guys have a great weekend ahead. Yeah. Thanks, Annie. Thanks, Robert. Thanks, Ed. Thanks, Ding. So it was really nice that you guys came up, and it made all the effort worthwhile. And as I said, please feel free to ask more questions. Feel free to suggest more topics you really want to cover, and we'll try our best to cover them in the regular webinar sessions that we have. Thanks a lot, and have a great weekend, everyone. Thank you. Bye-bye.